Debbie Marcoux is licensed by the Department of Financial Protection and Innovation under the California Residential Mortgage Lending Act, NMLS ID 237926. Also licensed in Arizona 0941504, Florida L076508, Georgia 69178, Idaho MLO 208023796, Illinois 031.0058339, Missouri, North Carolina I210940, Nevada 57237, Oregon, Tennessee 184373, Texas, Washington MLO 237926.
She's the mortgage mom. She can get things done when you're in need and don't know where to go. Pick up the phone and call mom.
All right, so welcome to Mortgage Mom Radio. I'm Debbie Marcoux. I am the Mortgage Mom. And today we are going to be talking about interest rates. They are coming down, which has been great. I've mentioned it on my shows before that a lot of times, although they don't directly correlate, interest rates will move with oil. So as the price per barrel starts to drop with oil, many times we will see that interest rates start to come down as well. So this is fabulous news that we're seeing these interest rates come down. But we need to talk about refinances and closing costs because right now, with interest rates moving in the downward motion, on the downward escalator, there are going to be many people that can benefit from a refinance. So we want to talk about what that refinance is going to cost you and at what point in time does it make sense for you to pull the trigger to do the refinance. So I can see that my dad, my biggest supporter, did get on. So he says, hi, everyone. Hi, Bug. So thank you, Dad. Sure do appreciate it. And I do want to remind everybody that this is an interactive show. So if you have questions, please put those into the feed. I am going to read them out loud and I'm going to answer them for you. I want to make sure that you're getting the information that you need. If you are here right now and you are watching, give me a thumbs up, say hi. But again, please make sure that you feel free to put those questions into the chat. I will make sure that I answer those questions for you. Annette did get on and she says hello. So Annette, thank you so much for joining. Sure do appreciate it. And again, I just want to remind everybody, you are more than welcome to let me know that you are here. So once again, today we're talking interest rates. They are coming down, which is fabulous. How much have they come down? Well, we're not quite to where we were back in October of 24. Those were by far the best interest rates that we have seen really since they started to increase the Federal Reserve prime rate towards the end of 2021 and really crazy stuff in 2022. And then also, continued to increase that rate into 23. So we are not quite to where we were in October of 24 when we had that nice rate rally there. But we are getting there. We are getting very, very close. So to give you an example of where we are today, again, I have to throw the disclaimers out there because everybody gets a different interest rate depending on their situation, right? So we've talked about this, but let's hit it again. The type of property that you have, if you're a single family home, a townhome, condo, one unit, 2 units, 3 units, 4 units, depending on the type of property that you have, will affect the interest rate. What your credit score is will change the interest rate. Whether you are choosing to include property taxes and your homeowner's insurance in your monthly payment, or whether you like to pay those separately, that will affect the interest rate. What are some other things? Gosh, there's so many things that go into it. Your loan balance. So what is the loan balance that you have that you need to refinance or that you are purchasing? How much is your property worth, or what is the purchase price of the property? So how much equity do you have in the property? How big is the down payment, or how much equity is in the home? So what is your loan to value? So these are all things that will change these interest rates, which is why I can't throw out an interest rate and say, interest rates 2.99%, call me today, let's get you going. It's just that's not right. And there is no commercial that should be doing that because nothing can be guaranteed to anybody. But to give you an example, let's run through it. Last week, let's go back to Monday of not this past Monday, but the Monday before. If you were a standard refinance, conventional, you had 20% equity. you were not trying to pull cash out of your property, we would have been at an interest rate that was right around 7.5%. If you were an FHA file and you were doing the same thing, just trying to get a better interest rate, not looking at taking cash out, and you had a decent credit score, so let's say that you're 700 or above, that FHA interest rate last Monday would have been just below 7%. So it would have been about 6.875. As of today, we are locking in FHA refinances right around 6.25. So you can see that that is a huge jump in where interest rates have been. And we are locking in those conventional refinances under 7%. We're right around 6.75 today. So it's a big move for just a little over a week. Very, very big move. Is it going to continue to drop? That's a big question, right? That's the big question mark. I sure hope so. The way that the market is looking, it appears that we should see still a nice little rally, probably for the next couple of days to a week or so. And then we're probably going to taper off again. And this is what happens all the time. We always see a nice little run down, and then it stops, and then we see a run back up again. Now, it never is going to go quite as high as where it left off the time before. And then it'll kind of do another run downward and trying to push the limits of where we landed the time before. So we are in our downward motion right now. And the hope is that we're going to continue to stay in that downward motion. Now, think about it. We are already February. What is our date? February 26th today, right? The last time that we had interest rates that were almost where they are today, so they were a little tiny bit better than where we are today, was in October, and it was actually early October. So we've gone November, December, January, and most of February. That is 4 months. And we still haven't yet hit those numbers where we were before. So we're going to see those numbers again, I'm sure of it. And they're probably going to happen in this little rate rally that we've got going on right now. And it is really important, if you've been thinking about trying to refinance, to get that application started so that we can hit the lock button when we need to. But what is going to happen, again, like I said, is that it is an up and it is a down. So we're going to come on down and we're going to stop, and then we're going to shoot back up again. So the question for you is, do you have time to wait a year? Do you have time to wait a year and a half to lock into an interest rate? Do you have time to wait 4 months? The last time that we had everybody locking in back in October and kind of getting excited about it and being able to take advantage, those people that didn't take advantage, that didn't get the application done, that didn't get their files started and the rate locked, have been sitting on hold since October. We've got quite a few clients sitting on a list right now that are just waiting for us to get back to those interest rates that we had and that they didn't get there fast enough to take advantage of. So if you have been thinking about doing a refinance, you want to get that started right away. You want to get that application going. We do not have to lock in an interest rate because you start an application. It is your choice as the consumer to float the rate or to lock the rate. And that is something that we do talk about. Do you want to float? Do you want to lock? At the end of the day, it is your choice, the person that is applying for the loan, when we lock your interest rate. Many loan officers, and it's true, this is very true, and I'm not trying to put anybody down, but many loan officers will lock you in and not tell you that it was your choice to lock in. It is your choice when you lock that interest rate. So we can start your application and you can say, Debbie, this is the interest rate that I want to do this at. If the rate gets to this number, lock me in and let's go. And that is what I have to actually do for you. But if I don't have an application in my system, I cannot lock in an interest rate. So keep that in mind. You have to have an active loan in the pipeline in order to lock an interest rate. So you want to get things going if you can, especially if it's something that you feel would be beneficial for you. So now let's really quickly talk about the people that it would be beneficial for, that would be, good at this point in time, that should be giving us a call and talking to us about it. And then we're going to get into those closing costs that I mentioned at the beginning of the show. So, number one, who would this be good for right now? I have quite a few clients that I did loans for throughout all of 2023. I'd say middle of 2022, all of 2023, and all of 2024, except honestly October when we had that very quick dip and it lasted for about 3 days. But the majority of the clients that have done loans, whether it be purchase, whether it be refinance, but mainly purchase throughout most of 2022, all of 2023, and the majority of 2024 have interest rates that are well into the 7% range. And when I say well in, I have clients that we did loans for that were at 7.875, 7.75, 7.5. If we can get you into an interest rate that is at least a 0.5% lower than what you have today, then we want to look at those numbers. Now, I'm not going to guarantee you that it makes sense to do it just for a 0.5%. It depends on your loan balance. It depends on how much that you owe. The lower that your loan balance is, the bigger that the rate savings has to be in order for it to make sense to pay the closing costs to do the refinance, which is why we're talking about this before we get into closing costs. So if you have a loan amount that's $200,000 or $300,000, you really may need to see a 3/4 to even a 1 point change in the interest rate before it makes sense for you to do a refinance. So if you're at 7.5%, you really may need to wait until rates are 6.5, maybe even 6 before the numbers make sense. However, if you have a loan amount that is $450,000, $500,000, $800,000, $1 million, and a lot of you that are listening to me today are listening to me from California. Yes, I do lending all over the country, but I started in California and I've been doing lending in real estate there for 30 years. So many of you that are watching are in California. It is not unlikely that your loan balance on your home is $600,000, $700,000, $800,000, $900,000, and that's being conservative. If those are your numbers, we are not talking about a big change in that interest rate to see a very good improvement in your monthly payment. So in that position, I would say if you have a 7.5% interest rate and you can get down 0.5%, around 7, then it's probably worth it. And we want to look at those numbers. Now, if you're at a 7%, 7.5% interest rate today, and I can get you to 6.75, it is going to be well worth it. So let's start talking about closing costs, okay? And where I want to start is I'm going to start with FHA. And the reason I'm going to start with FHA is because most people that would want to do a refinance who have an FHA mortgage will be looking at doing a streamline refinance, an FHA streamline. Unless you need cash out of your home, there is really no reason to go with just a regular standard refinance when you could do a streamline. Why do a streamline? And this is going to go consistent with a VA as well. So if you have a VA loan and you have a higher interest rate, you could be also streamlining your VA loan. So just listen very closely for FHAs and VAs. So with a streamline refinance, they do not want you to borrow more than what your balance is today. The goal of the streamline refinance is to lower your monthly payment and not increase your loan balance. So keep that in mind when we're talking about doing a streamline and closing costs. So with a streamline, your loan balance will remain exactly what it is that you owe today. It will not change. However, there are closing costs that need to be paid. With a streamline, we do not have to do an appraisal, which is awesome. We do not have to get your W-2s. We do not have to get your pay stubs. And this runs again concurrently with a VA streamline. But with an FHA streamline, which is different than a VA, so VA, you can finance your closing costs. They do allow that with a streamline. With an FHA streamline, you cannot finance your closing costs. You cannot. You have to pay your closing costs out of pocket. So it's really important that we talk about what those closing costs will be. Now, number one, when we do a streamline refinance, there are two ways that we can do the refinance. Number one would be lender paid closing costs. And number two would be borrower paid closing costs. When the lender pays your closing costs, essentially what they're doing is they are taking a rebate, and this goes for a conventional loan as well. So across the board, all mortgages, VA, FHA, conventional, jumbo, this is going to hold true for all of these scenarios, okay? So we can do a lender paid or we can do a borrower paid refinance. So how does that work? The lender will get a rebate, so basically a larger commission on the loan for doing the loan for you, if they sell you a higher interest rate than what the going par interest rate is that day. So let's just say, for example, today's interest rate is 6.5. And these are just examples to make this make sense. If I give you an interest rate, let's say that it's 6.75, I may be able to get a rebate for giving you the higher interest rate of $4,000. So what do I do as the loan officer with that $4,000? I don't pocket that money. I take that money and I apply it towards your closing costs to cover your closing costs. So that is how we help people do streamline refinances, even though because they're not allowed to finance their closing costs. I can't increase your loan balance to cover the closing costs that are due. So what typically ends up happening, refinances, again, straight across the board, FHA, VA, conventional, jumbo, refinances on average have closing costs which are non-recurring. So we're going to talk about non-recurring and we're going to talk about recurring. They're two different things. Non-recurring closing costs are the closing costs that you pay to get this new loan that are one-time fees. So an appraisal if it's required. So I just said with the streamline, not required. With a regular loan, possibly required. And we'll get into that. We'll get into conventional in a minute. Escrow. There has to be an escrow company with every transaction. Title. There has to be title insurance with every transaction. Credit reports. Everything that you need, those one-time fees to make that deal happen, to make that refinance happen, are non-recurring closing costs. That is what your loan officer is going to be able to cover for you in a streamline, conventional, jumbo, VA. Definitely an option that you can call and say, I would really like to have a lender paid refinance. So those are the costs that the lender can cover for you. So what can the lender not cover? So the lender can cover your recurring closing costs, but your recurring closing costs can get kind of pricey, and they are your recurring costs. So what exactly does that mean? So you own a house today. You have a mortgage today. You have property taxes that as the owner of that property, you are responsible to pay. You have homeowner's insurance that is ongoing. You are responsible to pay for that homeowner's insurance. And you have mortgage interest for the loan that you owe. So recurring closing costs are those costs that are going to continue. Whether you keep your current mortgage or whether you get a new mortgage, those costs are going to continue as a cost of homeownership. So those costs, if you have your taxes and your insurance impounded into your mortgage, so if you have it impounded, or another word that people like to use is escrowed, if you like to have that all bulked into one mortgage payment so that you never have to worry about a big tax bill or about your homeowner's insurance coming due, if it is all lumped into one, then we have to establish an escrow account for you or an impound account for you. Those two words go, they can be used back and forth. It's the same thing. So we have to establish that account. If you look at your current mortgage statement, most servicing lenders on the mortgage statement will show you every single month what your current escrow balance is. The money that is in that account is what you've saved up every time you've made a payment. It's the money you've saved so that when the tax bill is due, the bank can pay the bill. When the insurance is due, the bank can pay the bill. So that is something that has to be reestablished with every new loan. So how do we do that? So with a streamlined refinance, FHA, now VA, you guys can choose to finance that new cost into your new loan amount. You can choose to bring that money in out of pocket. Conventional, same thing. You can choose to finance those items and you can choose to bring it out of pocket. But how do we do it with an FHA streamline to make it more affordable for you? That impound account that we need to reestablish will typically run about the same amount as your current mortgage payment. So if we close, let's just say, for example, you call me today. It's February the 26th. I have to keep looking at the date. I'm like, oh my God, it's going so fast. But you call me today, February 26th. We start a refinance and I get your loan closed March 26th. Let's just say. Let's call it the 28th. So now typically you're going to make an April 1st payment, right? You make your March payment, you make your April payment, you make your May payment, right? Typically you would be making a payment April 1st. Instead of skipping that payment, so again, if you want to finance all of your closing costs and then you want to skip a mortgage payment and then you want to wait for the refund from your current lender for the balance that's in that escrow account on that statement, you can do all those things, but not with an FHA streamline. The FHA streamline, we can't increase your loan amount. So you're either coming in with money or you're not doing the refinance, right? It's just there's no other way around it. So instead of skipping the mortgage payment April, what we have you do is we have you make your April payment to the escrow company or the title company, the closer for whatever state that you are in. We have you not skip your payment. You make your payment. That payment amount is going to be what is needed to cover that new impound balance. Now, not all hope is lost. Because you did a refinance, you're still going to profit in some way. Usually you get to skip a mortgage payment. In this situation, we're telling you that you're not going to skip your mortgage payment, but you are still going to get a refund from the current lender that we are paying off. So let's just pretend that your current mortgage is being serviced by Lakeview. Many people have Mr. Cooper. Many people have PennyMac, AmeriHome, many servicers that we see out there, Loan Care, right? So whichever one is hitting home for you as I'm talking about this, you're looking at that mortgage statement. You're seeing that you've got that escrow balance. That escrow balance is $5,000, let's just say. Within 30 days of us paying them off, they are required by law to refund you any money that is sitting in that escrow account. So you will end up getting your check back. So that is how we make a streamlined refinance work. We give you a lender credit to cover your non-recurring closing costs. You continue to make your payments, never skipping, and then you end up getting a refund from your current mortgage lender, whatever that number is that is in your current escrow balance. So that is how we can do that FHA streamline. Now with a VA streamline, conventional loan, jumbo loan, those loan types will allow you to finance your closing costs, all of them recurring, non-recurring. So this is going to come down to you personally in how much do you want to take out in a new mortgage balance? Do you want to finance all of the closing costs, take the very lowest interest rate that could possibly be available today, skip a mortgage payment, and then also still get a refund from your current lender for whatever is remaining in your escrow account? Do you not want to increase your loan balance any further than you have to, and you want to get a credit from the lender, but you still want a good rate, so you don't want a huge credit, you just want enough to cover, the actual cost of the refi? Then you want to finance the difference of the impound balance. You get to skip a mortgage payment and then you also get your refund. Or do you want to do it very much like a streamline so that you're keeping your mortgage balance as close to what it is today as possible? So there's a lot of different ways that you can go about doing a refinance and handling the closing costs. Do not get baited and switched. Do not misunderstand what you are hearing. There are going to be a lot of mortgage companies that are going to start jumping out of the woodworks, that are going to be running commercials on the radio and on the TV that are saying, call us now for a no cost refinance. So now you can understand that the mortgage mom told you that a no cost refinance is a little bit higher interest rate than where the par pricing would be that day. So you're going to probably get an interest rate that's about a quarter higher than what it could be if you paid your closing costs. And you're getting basically the lender using the rebate for the higher interest rate to pay your closing costs for you. So which way is better, right? Everybody asked me that. Well, what do you think I should do? So here is the situation, and this is going to be an honest answer for you. In today's environment, a year and a half, 2 years ago, it would have been a different answer. And so I never want anybody to think that I'm telling you what you want to hear just to get a deal. And that's not the case. A year and a half ago was a different situation. We were in an increasing interest rate environment. In the increasing interest rate environment where we are assuming that we are going to see higher interest rates every single month and every single day for the next however long that we're anticipating that to continue to go, then you want to get the very best interest rate that you possibly can. You may want to pay some discount points to buy that interest rate down. We need to get that payment to an affordable, comfortable level for you and something that you can hold on to long term until the market starts to change. Okay, we're not in that environment. We are in the environment right now that the market is starting to change. The market is starting to come down. The market is starting, to be on that downward escalator. And it's been doing this for a while now. You guys have heard me talk about it. But we've seen it now going on for a good enough period of time that we know that we're in the downward trend. Are we going to have bumps in the road? Absolutely. Just like I started the show off with, the best rates we've seen is October of 24. Then all of a sudden we went up almost every single day. Now all of a sudden we're starting to come down again. So the chances of us hitting those numbers that we saw in October of 24 is very, very possible, very doable. And I do think that we are going to get there here in the short term. Will it last? I don't think so. I think that we'll also then again have a bump in the road and the interest rates will go back up a bit. Then, a little bit further on from there, then we'll probably see them start to come down again, right? But we're in a downward trend. So what does that mean to you? So what that means is we could refinance you today, and all of a sudden in 3 months or 4 months from now, interest rates could be better again, and they could be good enough that it makes sense to do another refinance. So what we want to do right now is we want to limit the amount of money that you are spending in closing costs, because that is, you need to be able to make up what it costs you. You need to be able to break even. So let's just say that you end up spending no money on the non-recurring closing costs, so the one-time fees, right? Because those are the true closing costs of the refinance. Let's say that you have the lender pay those. Then that refinance did not cost you anything. So if interest rates drop again in 4 months or in 5 months or in 6 months and it makes sense to do it again, there is no hesitation. You can do it again. But if that refinance cost you $10,000 or $12,000 or $15,000, do you want to do it again? Well, no. It's going to depend on how much money did you save. So let's just pretend that those costs, you do the refinance, you don't get the credit, you take the lowest interest rate possible, and the total amount of those non-recurring closing costs is $5,500. Let's just say, okay? And let's say that you are saving $300 a month. So you need to wait 18 months to break even. We don't want you waiting 18 months to break even, because in the downward escalator of interest rates, we want you to be able to take advantage today with $300 lower in payment. Take advantage again in 6 months with another $300. We don't want you to feel trapped because of money that you've spent in closing costs on a refinance. So I hope that makes sense. Now, the number that I would tell you that a refinance cost is going to change again based on your loan amount. So it is hard for me to give you an actual number to expect for closing costs. Your title insurance is based on your loan amount. So think about, the higher the price of the car, the higher the price of the home, the more expensive that insurance is. So your title insurance is the same way. The insurance is going to be more for the higher that the loan amount is. And your appraisal. The bigger that the home is, the higher in value that it is, the more expensive that the appraisal will cost you as well. So those things are going to factor into what are your closing costs going to be. But on average, your lender costs, when I say lender, again, I'm bulking it all together. Your escrow company, which is not your lender, the title company, the notary fee, the credit report fee, the appraisal if it's needed, your underwriting and processing fees. So all of those things all bulked in together, I would say on average are between $45,000 and $5,000. So if you can get a credit from your lender to offset that dollar amount, it is going to help you to break even much, much quicker and open you up to the possibility of being able to refinance again within a very short period of time. So it is happening. We are doing it. We are offering lender credits. Interest rates are coming down. If you have an interest rate that is, I would say, let's start here. FHA or VA. If your interest rate is currently 6.5% or higher, you should be reaching out to us to at least talk numbers. What rate do you need in order for it to make sense, and get on a list for us to reach out immediately when things get there. If your interest rate is over 7% on a conventional loan or jumbo, so any type of conventional financing whatsoever, not FHA, not VA, then if your interest rate is above 7%, you should absolutely be reaching out to us today. There's a good chance we could be doing it right now and you could be saving. And there is a chance that we're going to be talking about what rate do you need to get to in order for it to make sense. And we're getting you put on our list of people who are ready and willing and able and want to get started as soon as possible. So I do hope that this helped you guys. I'm trying to bring you something new every week that is relative to the market. This is great news, you guys. I haven't seen interest rates at this point since October. And like I said, October, we got about 3 days with where those interest rates were at before we just started going absolutely sideways and upwards. So I'm hoping that we can hit those October numbers again here very, very shortly within the next couple of days, possibly, maybe by end of this week. But how long will they stick around? They didn't stick around very long last time. So we had a lot of people inquire, a lot of people that wanted to get things done, that took their time, assumed that we were, things were coming down. They wanted to wait longer. They wanted to wait for the interest rate to get even lower. And here over the last 4 months, they could have been saving $200, $300, $400, $500. I mean, I have a client right now I've got her application in the system. We have not refinanced her loan yet, or she's in the system. She is in underwriting. We have not locked her interest rate in yet. At the interest rate that we want to give her, which we are probably about a day away from being able to lock in, she is going to be saving $750 a month. So it really does depend on your loan amount. It depends on the type of loan that you have. It depends on where your current interest rate is. But that is what we are here for. We are here to help guide you, do the numbers with you, show them to you, and determine where is your best savings, at what number do you need to make it to. And if you don't know that, you don't get it started, then you're missing out on the savings if we do start to jump back up the other direction. So do not wait. Get yourself rolling if it's something that you feel would be good for you. How do you do that? So you want to talk to me directly? I'd love to talk to you. You guys are going to get me. You're going to call the office. You're going to get me. So you can either call my office at 844-935-3634. That's 844 We Lend for You, WELEND, and the number 4. Or you can go head over to my website. Go to mortgagemomradio.com, and there is a appointment button. Click on the button. Make an appointment. That is going to go directly to my calendar, and you are going to get a phone call from me directly, and we are going to discuss your loan and your information and figure out if this is something that is right for you. If you've been looking to do a purchase, I know today's show is about refinancing, but if you have been looking to do a purchase, again, just book an appointment, guys. Super simple. You can see my entire calendar and you can book for whatever day and time works best for you. If you just have a question, send me an email. You can contact me right through the website as well. If you want to make sure that you do not miss a live episode, you guys can opt yourselves in to get a once a week text message from me with the link to the show. So feel free to do that. You can do that at my website as well. It says live show. Click on that and opt yourself in. Super simple. So that is mortgagemomradio.com. Do not forget the radio. And last thing that I want to tell you guys is that if you want to try to figure things out on your own, because I am kind of like that, and I can understand maybe not being ready to make a phone call. If you want to try to figure out what interest rate do you need before things make sense for you, how much savings do you need to have for it to make sense, then why don't you download my app? You guys should really have the Mortgage Mom Radio app on your phone. Now, this app is not the app that is in the App Store. There is a Mortgage Mom Radio app in the App Store. That is for when you are completing a loan application, when you are in the system with me and you are moving forward in a transaction. But if you want to have my Tools app, which has my calculators, and you can play around, put in your loan balance, put in different interest rates, you can enter your annual taxes, your annual homeowner's insurance, and you can see what the monthly payments would be. And you can explore how much would that be in savings. If you've been thinking about purchasing a home, there's an affordability calculator in there that you can enter your information to get an idea of what you might qualify for. So again, for that person that maybe wants to do a little work on their own and a little exploring before they either schedule an appointment or call the office, get my Tools app. So how do you get my Tools app? So you guys are going to text phone app. Okay, so phone app, 2 words, text phone app. You will get a link back to save the app to your phone. So I will text you the link to my app and you will get the link from me. So you're going to text phone app to my 844 number, same as my office when you call me. So it's 844-935-3634. That's 844 We Lend for You. WELEND and the number 4. So text phone app to that number. You will get my phone app. It's my Tools app. It's got awesome calculators on it. You can do your application right through that app as well to get things started. But it is the Tools app. It's got calculators. It's got all kinds of things on there. Home buyer workshop. How to contact us. You can call me right through that app. So tons of great things that are on that Mortgage Mom Radio Tools app. So again, text phone app to 844-935-3634. I don't see any other questions coming in today, so I'm going to go ahead and stop the show here. I will be back again next week. If you have questions in the meantime, go to the website, send me an email, give me a call at my office, send me a text message. You guys can, to my office phone can accept text messages. There's lots of ways to get a hold of me. You guys can absolutely do that. Book the appointment, whatever that you need. Again, it's mortgagemomradio.com. I'm Debbie Marcoux. I am the Mortgage Mom, and I'm here every Wednesday, sometime around 1. Today we started a little bit early. I started at noon instead of 1. But if you want to get that link every time I start live, then make sure that you sign up to get those live stream notifications. I hope you guys all have a great one. I can see my dad says goodbye. So goodbye, Dad. Love you. And I'll talk to you guys all real soon. Bye-bye.
Debbie Marcoux is licensed by the Department of Financial Protection and Innovation under the California Residential Mortgage Lending Act, NMLS ID 237926. Also licensed in Arizona 0941504, Florida L076508, Georgia 69178, Idaho MLO 208023796, Illinois 031.0058339, Missouri, North Carolina I210940, Nevada 57237, Oregon, Tennessee 184373, Texas, Washington MLO 237926.
She's the mortgage mom. She can get things done when you're in need and don't know where to go. Pick up the phone and call.